Hey guys, how's it going today? Dave Pettit here with my friend Patrick McCarroll. Just wanted to talk a little bit about the market, kind of bring you guys an update of what's going on. It's been a pretty wild ride out there, brother, right?
Yeah, that's an easy way of saying it.
It's definitely been interesting, right? We've talked about many times before, but at the root of all this is inflation, right? And it's interesting because when you talk to people on the street, it is it's starting to hit a little bit, right? I mean, you're in Texas. I'm in Utah. We work all over the country. But I had a friend that I talked to a couple days ago. He owns some car dealerships in Colorado, and I was asking him, how's everything going? He says, man, it's, brutal is a good word to describe it. We're starting to feel the pinch. I talked to a guy this last weekend who does business with some major retailers like R.C. Willey and Home Depot, and the orders that they were getting for the particular products that they were selling were about 3 to 4 a week out of the 17 stores that he serviced for Home Depot. And he said, we're lucky if we see one every 3 weeks now, kind of kitchen cabinet, countertop related, something like that. Thought, man, this is really interesting. It feels like people are pumping the brakes a little bit. But the numbers, the numbers are this Fed and all of their, whatever we want to call it, they really are having a hard time seeing the forest for the trees, right? I mean, they're looking backwards. They want to see that 12-month. They want to see everything kind of come into the scope that they're looking at, right? But really, I mean, if we take it, in fact, I'm going to share my screen here, and we're going to jump right in if that's all right with you.
Fire away.
CPI numbers came out for the month of August. Let me just share this here real quick. And headline was at 0.6 month over month, and core at 0.3. Okay, well, year over year down on the core from 4.7 to 4.3. But really, our last couple of readings have been in the 0.2, 0.3 range for like the last quarter, right?
Yeah.
So if we look at that, core inflation really is getting closer to that 3%. It's not the 2% that the Fed wants, but we still have a lot of rate hikes that haven't hit in the 12-month scope, right? In the last 12 months. So talk a little bit about why core
over lag.
Yeah. And what are they? The Fed. We always say the Fed's favorite gauge of inflation is that core metric, and why is that?
It's simply put because energy and food expenses are far too volatile, right? You can move with price swings. Just look at what we've experienced with gasoline prices. I think it was just 60 days ago, gas prices were in the low $2 range. Now some states are already at $4. So the distribution cost of all of that energy is just way too volatile to really gauge a monetary policy off of. And the core strip allows it to be a little slower, which allows the Fed to respond in ample time.
One of the things that's interesting about that is they do try to strip out the fuel costs and whatnot, like you've seen. I mean, I don't know about in your area, but when I was driving up from Las Vegas to Salt Lake City this last weekend, there were several places that I passed that diesel fuel was over $5 a gallon again. I mean, it's insanely expensive. So, one of the things, this airline fares makes up 0.7% of core. Well, oil and price do trickle into that inadvertently, right? I mean, they're directly kind of stripped out, but of course, fuel costs have something to do with the makeup of airfares, of course, right? So it's impossible to take that out completely. What are you guys seeing for gas prices down there in your area?
So regular unleaded, probably, I think it's $3.30, $3.40. Diesel's up to about $4.10, $4.20, contingent on kind of where you go. Yeah,
well, it's definitely interesting. At the high, we were just talking about this before our call, but at the high, inflation was really out of control. I mean, that headline number was around
9%.
Yeah, around 9%, and we're down to 3.2 on the year over year, which is pretty impressive. So, we are making headway. The soft landing that the Fed's talked about, they really are kind of hell-bent on achieving that. And, is it a possibility? Who's to say it at this point? It looks like we're coming in hot and heavy. But, what are your thoughts on that? Where are we going with this thing?
So the biggest thing to remember when you're kind of putting this together is the financial world operates in speculation, right? So if I want to go buy a stock, I'm going to purchase the stock under the idea that the stock price is going to grow. I'm speculating the stock price is going to grow, right? And I want to jump in, purchase that stock before said growth happens. Creates a return on investment for me. So what has strangled the markets so tough over the past, even look at the past year, right? There were times when interest rates had gotten all the way down to 5.9%. 30-year was just fluctuating back and forth. We're going to 7. We're coming back down to 6. We're going now to 7.65. So it's kind of all over the place. So what's been happening is the market and the Fed have been in kind of this little dance, right? Where the markets are trying to get ahead of the Fed, this idea that there were going to be rate cuts. They were going to come sooner than later, so the market starts to price in the idea that those cuts are going to come. So a lot of really big things happened at this last Fed meeting, right? One of which was not directly associated with the actual meeting itself, but the idea behind one of which the Fed had previously stated in July, the idea that 2024 was going to come with 4 rate hikes of 25 basis points, right? Or rate cuts of 25 basis points.
Right.
They changed that in this meeting to 2 cuts of 50 basis points. So the markets, when the Fed tells them something, just like when the Fed told us inflation was transitory, the markets believe that, right? And everything started to price in accordance, and a lot of that has to do with where we are today. Was a Fed that was late to the party by 6 months, and we were still purchasing assets in the face of 6% inflation. So that's still a long way down, but it's under the idea that the markets still take the Fed for their word. So when the Fed says, hey, we're going to cut 100, the markets get ahead of that, right? And they start to cut 100 along with it. And what the markets don't like is to be surprised. They don't like to be caught off guard. So when Powell stands up there and says, hey, oh, by the way, we've taken 100 to 50. The markets are like, holy cow, we're priced out now by 50 basis points. Now we got to jump way ahead of that. So secondarily, the Fed had articulated the idea that the first cut was going to come in March, right? Now they've kicked that can down to July. So now the markets are like, hey, we're way priced outside of this. Thirdly, the Fed had changed the dot plot, which is something that you were going to talk about, which every other meeting, every voting Fed member has to not only state what they want to do with the Fed funds rate today, but they have to plot where they believe that Fed funds rate is going to be in the future. So it's the remaining, meetings for this year. It's what it's going to look like in 24. It's what it's going to look like in 25.
Yeah.
So what really kind of punched the market in the gut a little bit on the triple whammy here was every single bet from July went up by 50 basis points, right? So where everybody thought rates were going to be in the July meeting, now everything's gone up by 50 basis points. So there were 3 different positions that that markets were really completely caught off guard by all 3 of those statements. So a lot of which, what we're experiencing right now, is market participants that are a bit afraid, right? They're a bit afraid that, does this Fed really have a handle on what they're doing? Do they see it? And there's a really scary moment that happened on CNBC the other day, and we won't name call of what Fed participant it was, but there was a Fed member that sat there on Squawk Box and 2 separate questions were asked, one of which, are we restrictive? Like, do you feel that we are restrictive where we are right now? Restrictive meaning the Fed hikes until it restricts growth to a place to where that they know growth is going to come down and their mission is going to be accomplished. And then secondarily, it was asked, do you have a handle on the lag, right? Like, how are you guys running the math based on all of these hikes that you've already participated in? The idea that it takes 12 to 18 months in some cases for each hike to fully manifest in the economy, do you have a grip on the math of that lag? And that Fed participant looked up and said, I don't know.
Yeah.
And there was a lot of fear that has happened. You've seen it in the trading since that day, that people are really getting ahead of, particularly market participants are getting way ahead of what could possibly be the absolute worst case scenario, because there hasn't been a lot of confidence in the Fed and their answers to questions to this point that they really know what this is going to do.
Right, and that realistically probably is the most honest answer, is that they want to believe that they've got a handle on it, but in all reality, they don't know, and that's obviously problematic. Let's take a look at this dot plot chart here. This is off of the website Bond Savvy, but this is the 2023 Fed dot plot of the projected year-end Fed funds rates. So this one, as we look at it, right now we're sitting at that 5.5 mark. You've got what I see here, and correct me if I'm wrong, is that we've got a little over half of the Fed, and again, these don't represent all the voting members, so we're not exactly sure,
right,
where those guys lie. But all of the Fed, they basically vote, and half of them are close to half are saying we don't need to raise anymore, but there's still some that are supporting another rate hike this year, right?
Yeah, I mean, there's still some saying we got to go to 6.
Yeah, and you have next year, right? You've got, if they're looking down the road, and these change like the wind, right? But right now, this just shows you how much they don't know, right? I mean, to your point, what are we going to do? Well, you have some people saying, let's see, 1, 2, 3, 4, up to 5 rate cuts in 2024. You have some saying none, and you have an outlier saying, shoot, we might have to raise more in 2024. The consensus is in the longer run, obviously, that will be lower, and you can see as it trends down through 2025 and 2026 that they'll have to cut. My personal thought is, for what it's worth, which is not a lot, because it's not like we've been able to nail this spot on. There's been so much data that's come out that it is hard to sift through, and it's hard to, honestly, some of it's hard to trust the integrity of the data because it's being amended so much. But I think that they're going to have to cut sooner than later once all of these rate hikes really and truly fully impact the economy. They're raising. And I think we're going to equally find ourselves in a spot where they're going to have to cut to try to keep up with, the influx, stabilizing the economy again. You know what I mean? So
yeah, I don't believe that they're going to be able to be bailed out by economic data. Mm-hmm. I have been of the opinion, you guys hear me talk about it almost every single day, that I believe you're sitting here on yields that we haven't seen in 22 years. I mean, think about the logistics of that, right? How many traders haven't traded that long, right? How many traders were here 22 years ago, the last time we were here? How many mortgage professionals were here? How many real estate agents were here? Like, we're in uncharted waters right now, right? And I think the Fed feels like they're a little bit in uncharted waters and territory as well. So I believe the idea that they have is something's going to break, right? So either employment's going to break, the labor market's going to crash, either there's going to be a credit event as student loan payments start to burden the American household again in October, right? We're starting to see credit card delinquencies rise a little bit. It was super interesting the other day that the very first journalist finally really pressured Powell in regard to, we continually talk about the strength of the United States consumer. However, it's all inundated in credit card debt, as credit card balances have exceeded $1 trillion for the first time in history. So one journalist finally had the gusto to kind of say, look, you're talking about this strength, but we're also watching it happen through credit, right? We're borrowing against all of this strength, and that's not strength at all. So what do you have to say about, these historic balances? And Powell didn't answer that question. Powell said, hey, look, we're we're paying attention to the delinquency ratio, and we're tracking that, but he had no answer whatsoever behind the idea that these credit card balances have gotten so high.
Yeah.
And now that the average credit card interest rate is 24%. So those payments are starting to become quite restrictive, right? Yeah. So maybe it's the consumer, maybe it's the labor market, maybe it's another regional banking situation. But I believe they're waiting on something to break to bail them out, right? And then the market will take care of a lot of this themselves with a really quick downturn. But I don't think that they're confident in the idea that they can just kind of softly land this thing and everything's going to be, all fine and dandy. Mm-hmm. NAR finally came out today, and NAR is begging the Fed to stop with rate hikes because, purchase contracts are falling, dramatically. They were down 8% month over month. They were down 18% year over year. So they're starting to feel a little bit of the tension there. New home sales were down 7.8% in July. That's the most recent number that we have. So you're starting to see cracks in the system, right? Yeah. And I think they observe that fact as well.
Well, and I'll just add two things to that. One, the market doesn't really care where the money's coming from, right? And so inflation will be driven as long as people are spending. So I do think, the Fed, it's not like the Fed has an easy job and I don't defend them often, but it's not like they have an easy job by any stretch of the imagination because the market doesn't care where that money's coming from. If it's being spent, it's being spent and services and goods are being inflated, right? And so that is going to come crashing down. The other part of that is the unemployment. I mean, it'd be really interesting, to see. We've got a big ADP report that comes out this a week from tomorrow, right? And so we'll see how that goes. Today, I think the initial jobless claims came out, and it didn't look great. But you're right. It could take something big. To your point, though, one of the most interesting things that's happening in this environment. Let me just see if I can pull this up real quick. This was off of MBS Highway, but home prices turning higher. So Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow, all through June and CoreLogic through July. And I think I want to see, or this might be an old one. I had one just from the other day that had Zillow through August even. And everybody's holding pretty steady in that 6 to 8% year over year national appreciation, right, in home prices. So 2023 appreciation pace still in that 6 to 8% is kind of the median consensus, right? So even though we're seeing purchase contracts fall, the demand is still there. It's still suppressed. There's still people waiting to come out of the woodworks to buy homes when either prices fall or rates fall, and it's looking like it's not going to be prices, right? So, to all the consumers that might watch this when we post it, I would still say our messaging from the rooftops is there's never going, or I'm not going to say never, but the next few years, there's not going to be a better time to get into a home than today, right? And I don't know if I think you'd agree with that, but for me, I look at it and I see when rates start to come back down, if prices aren't going down now with the purchase contracts and whatnot going, falling off a little bit, if home prices aren't going down now, when rates come back down, more inventory hits the market. There are hundreds of thousands of potential home buyers that have been suppressed by this market that are going to come into it. We will see lower rates. We will see opportunities for refinances, but today is still a great time to get into a home. Agree?
Yeah, no, here's a really tough predicament that customers are in, right? To your point, in our market, inventory is still 52% below what it needs to be in order for price stability, right? So I went and looked at the average of months inventory all the way back to 1990 till today. It was some 400 months. And so our average is basically a 5.9 month supply. And we've always heard that, right? So getting to 6 months is a balanced housing market. That puts us right in line with that. However, we're still sitting at 2.7. So the number that we're at is still 52% below what we need to be, right? So sellers are not coming to the market. They're sitting on their 2%, 3% interest rates. So the buyers that are in the market are the ones that are still, having to compete for the limited amount of inventory that's there. And a lot of the inventory that is there is located in price points that are outside the average consumer's budget, right? So when you get into where the price needs to be in order to formulate median household income, that's a very competitive place right now, okay? So as you're rolling through, the decision that you have to make is, for us, one of the interesting things that we've seen is that demand fell 10.5% from August of last year to August of this year. So the number of buyers, the number of sales has fallen. But what was interesting to watch is that you have what's called the list to price ratio, right? So somebody lists a home, there ends up being an actual contract. So if you have your house for sale at $100,000, I give you a $97,000 offer. We close on that. That was a 97%, list to offer price or list to close price. So what I've noticed in happening is that as the demand has started to fall, that list to close price has gone from 99.2% to 96.1%, right? So as demand is falling and listing remains suppressed, then the buyers that are out there are finding themselves in more of a negotiating power, right? They're in a better place. So the interesting piece is that, and Joel and I were talking about this the other day, is what nobody knows is that even if interest rates fall to 5.5%, right? How many more opportunities is that going to create? Okay, because the struggle at hand that still lies. I don't know where your market is, but our market median price is still 4.9 times median household income. Okay, that has nothing to do with interest rate. That is simply how much prices are in comparison to income. And normally they're supposed to be 2.5, 3 times max, right? So we're 2 points above that. So the dilemma at hand is interest rates rush to 5.5%. It increases a minor amount of inventory, right? So there is going to be a number of buyers who are sitting at 3.5 that have the income to go, you know what? I'll go from 3.5 to 4.5. But there's going to be a large chunk, 70%, that still have a median income that doesn't match median price, and they're still not going to be able to participate. So I feel like there's a substantial chance that rates could fall. A number of sellers are still going to be locked in. That's still not going to improve the inventory levels to where we need them to be in order to alter price.
Right.
And you're going to create 2021 all over again.
Yeah.
That rates are going to fall, but you're going to be in such a competitive situation that you're going to have 5 buyers to every listed property. We're going to recreate having to spend $10,000, $20,000, $30,000 more than what the property's worth to win the bid. So again, there's no math to understand. Every mortgage company's trying to figure this out. Every real estate company's trying to figure out what's the housing market going to look like. And as Joel and I agreed, you're not going to know till you're there, right? So as a consumer, do you want to go ahead and try to find something affordable now, where statistically it's showing that hey, buyers are able to negotiate at a better stance than what they did even a year ago? Or do you want to take the chance? Do you want to wait to see what this looks like on the other side? And do you want to take the chance to find out that it's going to duplicate 2021 all over again? And now you're in a housing market with 5.5%, but I got to pay somebody $20,000 more than what the house is worth to play.
Right. Well, and how many people in 2020 and 2021 ended up in houses that they weren't really truly happy with either, that they just settled for, and I agree, and I wish that I saw it a different way, but I just don't. If the home prices are being sustained right now, and for all the reasons that you just said, I don't see a world in the next 5 years, especially in our market here. You guys are growing like crazy. We're kind of captive here on what we call the Wasatch Front here in Utah. There's no more. We can't expand in different directions. We're kind of captive by this mountain. So it's not like we look at the buildable acreage here. There's not a lot left, right? Unless you go to the outskirts. So It is. It's going to be interesting, but I still, I believe that today is that bird in the hand. You go negotiate, you get the property that you want because you have a chance to actually get that, right? You actually even have a chance to get that with some of the, the low to no down payment programs that sellers were turning their nose up to a year and a half ago, right? If you were coming in with an FHA or a DPA down payment assistance type offer, they would just, no, we'll go to the next guy. We'll go to the cash buyer. You have an opportunity to get into those today. Rates will fall. History will repeat itself. And you'll have an opportunity to get into a better payment down the road. But if you can swing it right now, there's not going to be a better time to do it, because how many people are not going to like you said, sell the house in 2 years and upgrade just because, hey, I'm comfortable, I'm in a spot, got my house for a better price. 4 years ago, I'm at a 3% rate. I just think that inventory is going to be a challenge for quite a long time. So, brother, I appreciate you. This is Mr. Patrick, my MBS guru here, and I appreciate you being on today. We always go a little longer than I anticipate because there's so much good stuff to talk about. But reach out to us if you guys have any questions at all. We're here to help. We're here to kind of navigate through these muddy, uncharted waters with you. And we'll be the first to admit we don't know everything. I certainly don't. He knows more than I do. But these are uncharted waters, and we're doing the best that we can with the information that we have, waiting for the next bit of information to drop, and we'll be all over it for you guys. So thank you, sir, for being here today, and it's been a pleasure, and I'll talk to you soon.
You bet, brother.
Have a good day, buddy.